Welcome to the Simply Financial podcast. I'm your host, Christopher Calandra. On today's episode, I want to talk about individual 401ks. In the marketplace, they go by a couple of different marketing names. Could be a single K, solo K. There might even be others, but these are basically 401k retirement plans for owner-only businesses where there are no employees or non-family member employees. So to talk about this topic, I asked Kristen McGarry, Senior Vice President from Pacific Life, to join me to talk about this neat vehicle. It's a great planning strategy when it fits. She's a returning guest. My listeners love and appreciate her appearances on the show. So Kristen, how are you doing today?
I'm great. Thank you for inviting me back.
So I want to talk today about individual K. I know Pacific Life in particular, their program, your company's program, calls it individual K. But as I said at the top, it goes by different names, but basically solo, single, one person 401k, they all kind of fall under this heading. And I find, before we talk a little bit about it, I think, in my opinion, from what I've seen in the marketplace, is that this is an underutilized tool. The default for a lot of people is to immediately go to a SEP IRA, SEP IRA. It stands for self-employed pension. And there's nothing wrong with the SEP in and of itself. But I think in lots of instances, the 401k has some distinct advantages above what a SEP IRA offers. So let's talk a little bit about first, Kristen, give us the basics of an individual K, please.
Absolutely. So an individual K is for an individual that owns a business that has no employees except for family members. And it's similar to a SEP, but there's a handful of different features that you would get on an individual K versus you would get a SEP. And we're going to go through them. But one, for example, is Roth is available. A second one, for example, is you can take a loan, which you can't do those on SEPs. So it definitely gives some more potential options versus some of the other different types of retirement plans. I would say that it also depends what you're looking to achieve as a small business owner. For some individuals, if you're not looking to put as much money away, maybe a simple plan could work. But if you're really looking to try to maximize as much money that you could put away and you want flexibility for Roth and for loan, then that's where I think the individual 401k or the solo K really could be an opportunity.
So let's just go through the nuts and bolts. In a 401k, an individual 401k, like a 401k, if you worked for a large, mid, or small company, has high contribution limits. This year, correct me if I'm wrong, Kristen, but for all individuals, the limit is $20,500. I shouldn't say all. You need enough compensation to cover it. So you need the maximum contribution is $20,500. And if you're over the age of 50, you get a bonus. You have a catch-up contribution provision that could add $6,500 on top of the $20,500, giving you a maximum of $27,000. So that is pretty good contribution level. And like you said, depending on how you set up the individual K, that could be pre-tax contribution, reducing your current tax liability. It could be Roth, and it could be some combination. And oftentimes, as you said, those limits are higher than what might be available in a SEP IRA, or you mentioned simple IRA. Did I get all that right?
Absolutely. And in a simple IRA right now, the maximum is $14,000. And then the catch up for individuals 50 and older is $3,000, so maximum $17,000. So it is definitely a higher contribution amount that you're able to do with a solo 401k.
Beautiful. And from a planning perspective, we talked about families. So this is appealing in a situation where you have a husband and wife or a son and daughter that work in a business together. They would still qualify for an individual K because they are immediate family members. It doesn't extend out to like your cousin or nieces and nephews, but immediate family. And you could still use the single K, and then both, say husband and wife, father, daughter, could each put in that $20,500 or $27,000 depending on age. Is that right?
Correct. And a few other things to consider. It's immediate vesting. So for individuals that are listening that maybe work for a large corporation, you might have a vesting schedule of anywhere maybe 4 or 6 years. It's immediate vesting, which makes sense because it's your own personal money. And then cost effectiveness on administration. I know a lot of times you think about a 401k, we're going to have to pay a TPA or third party, we call TPA, third party administrator for your 401k. For solo Ks, it's a very reduced fee that you would pay the TPA to be able to administer your 401k.
And these are costs, administrative costs to run an individual K that are typically higher than other options like regular IRAs, regular Roth IRAs, SEP IRAs, and simple IRAs. But if you get some of these added features and it fits into a good overall plan, the cost is not huge and can be well worth it. So we talked about, Kristen, the individual contributions, that $20,500, and then if you're over 50, the extra $6,500, bringing it up to a $27,000 total. But that's not the only way that money can come into the plan. The employer could also make a profit sharing contribution that could also be termed an employer discretionary. And usually, Kristen, when I'm speaking to clients about this, it can be confusing, right? Because if I'm a one-person operation, let's say I'm a real estate agent or an attorney, no employees, and I talk to them about, hey, you can put in $20,500 as an employee, but then your employer could put money in too, that seems ridiculous. They're one and the same. So it is semantics, but in terms of how this works, it is an important notation, because when you file your taxes, where you put the employee contribution, the $20,500 or the $27,000, where you put that on the tax return is different than where you would put the employer contribution. So even in a one-person operation, they're one and the same. The way the IRS delineates this is the employee could put in the $20,500, and the employer, based on business income and profits, compensation, can make an employer contribution the same way you can if you work for IBM. Did I explain that okay?
Absolutely. And the way that the employer contribution works is it cannot exceed 25% of compensation. And for 2022, the dollar amount is $305,000. So it cannot exceed 25% of compensation of the $305,000.
So if we do some rough math, and I got to be careful here because the numbers are not exactly even, but let's say you make $300,000 as a sole proprietor, $300,000, and you're over 50, you could put $27,000 in as an employee. And then as the employer, you could put in 25% of the 300,000.
An additional 75,000.
That's right. Now we're doing the quick math here, and the tax filing, it's net Schedule C income. So, I mean, this is an oversimplification conversation, listeners. These are just rough numbers. Take this as a conceptual explanation on how this works, how it actually is applied when you use your taxes and you run your numbers. Might be a little bit different than these conceptual numbers we're throwing around. So please keep that in mind. But the point is, listeners, that you get the idea that on a decent income, you could sock a lot of money into the 401k, often more than can be done in other vehicles that are available. We talked about many of them already: IRAs, SEP IRAs, simple IRAs. Another feature, in addition to the high contribution amounts, and in addition to the ability to have family members that participate in the business contribute to the 401k also, we also talked about the ability to do Roth and pre-tax. Another benefit is the loan feature. Can you talk about that? I think you might have mentioned that in passing at the beginning, Kristen. Touch on the loan feature, please.
Yep, absolutely. So with a 401k, regardless of what type of 401k, you can take a loan out of 50% of the balance, or $50,000. And you cannot do that with a simple or a SEP. So that gives flexibility, where we have a lot of small business owners that might need to borrow money to put back into the business. Sometimes that will have individuals that are real estate agents and then see a home that all of a sudden they want to buy and they just need the money for a short period of time. We always want to be cautious on telling people if they're going to borrow money from the retirement plans. But again, it is available to be able to borrow against your plan up to $50,000. One other thing I wanted to go back to was the Roth option that you have inside of the 401k. There's a lot of listeners that are very interested in Roth, but can't qualify because of their income limits.
Good point.
You do a solo 401k or even a traditional 401k, those income limits don't exist. They call them the MAGI, the modified adjustment gross income levels. Those don't fall into place for your retirement plans. So there's a lot of listeners that can't do a traditional Roth, but could potentially do Roth inside of their solo 401k or their regular 401k.
No, that's a great point. I'm glad you went back to it. We kind of glossed over it, probably not serving the listeners well. So thank you for that. Yeah, I mean, somebody could make $1 million and not be eligible for a Roth if they have self-employed income, even if it's not their primary income, where it could be a side hustle or, they do some consulting on the side, something like that. They could get access to a Roth. Another thing that I see in the marketplace is you might have, again, husband and wife, traditional kind of setup. Let's say the wife is the major breadwinner. The husband has a side business, makes less money than the spouse, but you could set up an individual 401k for that secondary income and be able to sock a lot of money into the plan, not worry about the Roth limits, have another place to contribute if the primary breadwinner is maxing out at their employer. So that's another instance where this can be used as a great planning tool. So thanks for talking about the Roth. So with the borrowing, what I've seen is 2 examples of where this could come in handy. Somebody works for corporate America and they want to start their own business or just transition full-time into their business, but their business needs some capital. They could roll over their corporate 401k, their corporate retirement plan, roll it into their newly established individual K for their new business and borrow money out. It's a place that they could use to fund their business, perhaps in the early stages. Now, I know, Kristen, there is a lot out there about the negatives of borrowing money from your 401k. And I largely agree with the conventional wisdom. You want to be very, very careful about borrowing money from your retirement account. Generally speaking, it is not a good idea. But I wouldn't say that's true 100% of the time. And this is an example where it might make sense, where you could roll over your 401k, your business needs some money, you might not be bankable. Your business might be in its infancy and can't go get credit. So you could self-finance the business using your retirement account. You got to be careful, but I see that as a good, flexible use of the individual 401k. What do you think about that?
I absolutely do. And I've seen a lot of investors do that, to be fair, rolling in their balance from another retirement plan, now going into business for themselves, being able to borrow some money and then try to pay back pretty quick. But I think that's why the loan is there. That's why that option is there.
And then the other application of this loan falls under the heading of the adage, better to have it and not need it, and need it and not have it. So if all things being equal, you could put the same amount of money in a SEP and the same amount of money in the 401k. All else being equal, the 401k having the availability of the loan for a small business owner might be an advantage, because sometimes businesses have difficult periods. Sometimes opportunities present themselves where they need access to capital. And unfortunately, sometimes when you need to borrow is the exact time banks are not willing to borrow. And having that flexibility, that avenue in your back pocket is not a bad idea, even if it only gives you peace of mind that you can go borrow $50,000 to help out the business in a pinch or to capture an opportunity is not a bad planning technique either. So the downsides of the 401k are, we talked about the administration. You have some extra costs, a little extra work in calculating maybe the minimums and how to put all of this together. But if it fits, it could be very advantageous. Another disadvantage, I think, could we just talk a little bit about sometimes a business starts and it might be a one person, it might be husband and wife, like we talked about before, and the business prospers and they want to add an employee. At that time, you need to switch horses. You can't use this once you add a non-family member employee. Can you touch on that, please?
Great point. So what if the business was just you and your spouse, things are growing great. Now you want to hire one or two employees and they're not family members. At that point, you're then going to have to switch gears. And are you going to go to you would stop funding your solo K. You don't have to get rid of it. You would just stop funding it. So it would become dormant. It would stay invested, however you chose. But now would you do a simple plan? Would you do a SEP plan? Traditionally, once you hire employees, you're not going to go into a SEP plan because of the contribution is all from the employer, or would you go to a traditional 401k?
Yes, so that's a consideration. If you're listening, just put in the back of your mind, if you have an individual 401k and you add employees, that needs to be addressed with your team, your CPA, your financial planner, because the individual K is not going to work. So establishing the plan, assuming you don't have one, I think, Kristen, you need to establish the plan by the end of a business tax year. Most individual businesses, sole proprietors that we're talking about, are on a calendar year. Technically, they could be on a fiscal year, but I think that's incredibly rare. So for most people, most of the time, you have to set it up, establish it by 12/31 of a given year, right?
Correct.
And then funding, you mentioned any money that comes into the plan is 100% vested. So again, it's semantics, but if you put money in as the employee of this business, that's your money. If the business goes out of business or it gets sold, or you add employees and you need to go to another retirement plan, whatever's in the plan, regardless of how it got in there, is 100% yours. And let's talk about when you need to make the contributions by. Can you touch on that as we kind of begin to wrap up?
This is super flexible. So you don't need to make the contributions until tax filing plus extensions. So let's say you're looking at 2021. You already set up your plan in 2021, but you didn't contribute to it. And now you're trying to figure out how much should I contribute based upon the profits that we had in the company. Was the profits more? Were they less than prior years? So you don't actually have to contribute your portion or the employer's portion. Again, I know it's all yours until tax filing April 15th or tax filing plus extension. So it definitely gives you some flexibility.
Awesome. Very good. So if you are an individual with a business and you want to fund a retirement account, if you haven't taken a look at the advantages of an individual 401k over what you might be doing previously, I think it's worth a close look. Talk to your partners. If you're clients of ours, check in with us, check in with your CPA, but it is probably worth exploring. And if you're thinking about establishing a business and leaving corporate America, this is definitely something you want to consider. And there's also many, many other scenarios where this might be a consideration. If you have a side hustle, a situation where husband and wife have discrepancies in income, there's a lot of different ways that this could be a neat planning tool and a nice addition to a financial plan. So as always, Kristen, as always, I appreciate our business relationship and you joining me on this episode of the Simply Financial podcast. Thanks so much.
Thank you.
Listeners, I'll be back with you on the next episode of the Simply Financial podcast very soon. In the meanwhile, please subscribe to the podcast and check out my website, elliottwealth.com. If you're not a client and you want to talk to us, hit the button so you could set up a complimentary consultation. Thanks much. I'll be back with you soon.
The views expressed are not necessarily the opinion of SagePoint Financial Incorporated and should not be construed directly or indirectly as an offer to buy or sell any securities mentioned herein. Investing is subject to risks, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. Please note that individual situations can vary. Therefore, the information should be relied upon when coordinated with individual professional advice. Please note, the information being provided is strictly as a courtesy. When you link to any of the websites provided here, you are leaving this website. We make no representation as to the completeness or accuracy of the information provided at these websites, nor is the company liable for any direct or indirect technical or system issues or any consequences arising out of your access to your use of third-party technologies, websites, information, and programs made available through this website. When you access one of these websites, you are leaving our website and assume total responsibility and risk for your use of the websites you are linking to. Securities and advisory services are offered through SagePoint Financial Incorporated, member FINRA SIPC. Insurance services offered through Elliott Wealth Management, LLC, not affiliated with SagePoint Financial.